Hello friends, welcome back to my YouTube channel. In this video, I want to tell about the case, Stanford Financial Group Fraud 2009. The Stanford Financial Group fraud was a significant financial scandal that unfolded in 2009 and involved the prominent Houston-based Stanford Financial Group, SFG, and its founder, Alan Stanford. The case exposed a massive Ponzi scheme that defrauded thousands of investors out of billions of dollars. This case study provides an overview of the Stanford Financial Group fraud, including the key players, the fraudulent activities, the aftermath, and its implications on the financial industry. The Stanford Financial Group, founded in 1932, operated as a financial services company providing investment and wealth management services to clients worldwide. Alan Stanford, a Texas billionaire, was the mastermind behind the company's operations. SFG presented itself as a highly successful and prestigious institution, offering high returns on investments through certificates of deposit, CDs, issued by the Antigua-based Stanford International Bank, SIB. The Stanford Financial Group fraud refers to a major financial scandal that unfolded in 2009 involving the Stanford Financial Group, a financial institution based in Houston, Texas. The company was primarily owned by Alan Stanford, a prominent businessman and sports sponsor. Stanford Financial Group marketed and sold certificates of deposit, CDs, with high returns through its offshore bank, Stanford International Bank Limited, SIB. These CDs were promoted as safe investments, promising above-average interest rates. However, it was later revealed that the high returns promised by Stanford Financial Group were based on fraudulent activities. The company was operating a Ponzi scheme, where funds from new investors were being used to pay returns to earlier investors, rather than being invested in legitimate business ventures. In February 2009, the U.S. Securities and Exchange Commission, SEC, filed a lawsuit against Alan Stanford and his companies, accusing them of fraud and misleading investors. The SEC alleged that Stanford Financial Group had misrepresented the safety and performance of its investments, overstating the value of its assets and fabricating financial reports. As the investigation progressed, it became evident that the scale of the fraud was massive, with estimated losses to investors exceeding $7 billion. The fraud had international implications as Stanford Financial Group had clients and affiliates around the world, particularly in the Caribbean and Latin America. In June 2009, Alan Stanford was indicted on multiple charges, including fraud, conspiracy, and obstruction of justice. He was arrested and taken into custody. Subsequently, several other executives and employees of Stanford Financial Group were also charged in connection with the fraud. The fallout from the Stanford Financial Group fraud was significant, leading to the collapse of the company and the loss of billions of dollars for investors. Many people who had invested their life savings or retirement funds with the company faced financial ruin. The case also highlighted regulatory failures in oversight and raised questions about the need for stronger investor protection measures. The legal proceedings continued for several years, with Alan Stanford being convicted in 2012 and sentenced to 110 years in prison. Efforts were made to recover funds for the victims of the fraud, but the process was challenging due to the complex nature of the scheme and the international scope of the operations. The Stanford Financial Group fraud remains one of the most notable financial scandals in recent history, serving as a cautionary tale about the risks of fraudulent investment schemes and the importance of due diligence when investing. The fraud scheme. Stanford orchestrated a fraudulent scheme by promising investors unrealistically high returns on investments in SIB CDs. These CDs were marketed as safe and secure, with returns exceeding those offered by conventional banks. Stanford and his associates created an elaborate network of deceit to convince investors to deposit their funds in SIB. To maintain the illusion of success, Stanford consistently bribed and misled auditors, regulators, and prominent figures. He also created a luxurious image around his company by sponsoring sports events, including cricket tournaments and yacht races. These tactics helped Stanford gain credibility and attract high-net-worth individuals and institutions to invest significant amounts of money. The collapse and investigations. In February 2009, the Stanford Financial Group's fraudulent activities came to light when the U.S. Securities and Exchange Commission, SEC, charged Alan Stanford and other key executives with orchestrating a massive Ponzi scheme. The SEC alleged that Stanford had fabricated returns, misused investors' funds, and operated SFG as a global Ponzi scheme. As news of the fraud broke, panicked investors rushed to withdraw their investments, leading to the swift collapse of Stanford Financial Group. The ensuing investigation revealed that the company had misappropriated approximately $7 billion in investor funds. Legal proceedings and consequences. Alan Stanford was arrested in June 2009 and faced criminal charges, including fraud, money laundering, and obstruction of justice. In 2012, he was convicted on multiple counts and sentenced to 110 years in prison. Other key executives involved in the fraud, including former Chief Financial Officer James Davis, also faced legal consequences. The aftermath of the Stanford Financial Group fraud had far-reaching implications. Many investors suffered significant financial losses and struggled to recover their funds. It highlighted the need for stronger regulatory oversight and due diligence in the financial industry. The case also led to increased scrutiny of offshore financial institutions and exposed gaps in international financial regulations. The Stanford Financial Group fraud of 2009 represented one of the largest Ponzi schemes in history. Alan Stanford's deceptive practices and false promises of high returns on investments duped thousands of investors and resulted in billions of dollars in losses. The case shed light on the importance of robust regulatory measures and increased vigilance in the financial industry to protect investors and prevent fraudulent schemes. Subscribe to the channel for daily and new information related financial fraud with interesting facts case in history. Share the video as much as you can and like the video. Thank you for watching.